Last time we were looking at the kind of on these classification of advances we were looking at. On that, we were looking at what do we mean by on-balance sheet credit facilities. So on-balance sheet credit facilities are essentially fund-based, advances. So fund-based advances, why we have to segregate the fund-based and advances, and then which the other one is contingent, assets, what the bank has. So now, what happens is when you are granting a loan, you are parting with the funds. So that's a fund-based on balance sheet item. So examples are overdraft, term loan, block loans, packing credits, pledge loans, revolving loan, bills finance, discounting facilities, hire purchase, leasing, trust receipt, TR loans, pawning advances, credit card facilities, reverse repurchase facilities, right? Lending for debt instruments under standby credit lines. These are all called, on-balance sheet items because we have parted with the funds. So some of the terms you may not understand here, which are overdraft, term loan, block loans, and all. You know that packing credit is basically those are pre-shipment loans. In the sense, before exporting, people take advances from the bank for exporting, expenses on the exporting, right? Packing credits. Pledge loans are the goods which are imported, you pledge it to the bank and then take a loan, right? So if the imported goods are there in a stores, and then where the bank takes a pledge on that and then grant a loan. Revolving loans, bills financed, basically if there are any pending bills of exchange, basically when you are importing, let us say, say for example, you are exporting, in an export bill, till the funds come, you discount it, right? You discount it or purchase it. So bills finance, that way. A discounting facilities also, you're discounting a bill. Hire purchase loans. Hire purchase loans are basically on acquiring any asset. In that time, you go and do a hire purchase, something like leasing, right? Leasing facilities. Trust receipt is that, on a trust receipt, this also import loan. These are against the goods which are imported. So you go and lend it. Pawning advances, credit card facilities, repurchase is that, when you have treasury bills and bonds taken on repurchase, and then you basically keep it and raise, somebody else. Reverse repurchase, basically, let us say Sampath Bank wants to raise funds from HNP. So Sampath Bank gives their treasury bills under repurchase. They will give it to HNB and then ask HNB to fund. Say 500 million they want urgently. They'll say, okay, 500 million, I'm keeping my treasury bills on repo, what I have, and I will, before the maturity of the bill, I will settle and take the bill back. Those are reverse repurchase. So like for HNB is basically funding. So giving funds. So lending in them for debt instruments under standby credit lines. Say sometimes you have standby credit lines, right? Standby credit lines are what at times of emergency to use. What you create is the standby credit line. So these are all funded facilities, right? Basically, these are all funded facilities which are on the balance sheet. Those are called on-balance sheet items. The other set of things are what you call off-balance sheet credit facilities, which are not on the balance sheet because of the contingent nature of those. So, for example, if you know about letter of credit, So you open a letter of credit for a customer, and the letter of credit opened, which is there, but that doesn't appear on the balance sheet. Why? Because that is now you haven't funded still, right? You haven't funded still, but then it may become a funded advance the moment documents are submitted by the presenting bank, by the negotiating bank. The documents are presented sent as per the LC, right? So then we are liable. The bank which has opened the LC is liable. So those are, so LC liabilities are contingent liabilities. Then you take the other one is famous one is guarantees. Okay. All right. Okay. You can hear me, no?
Yes, sir.
Yes.
Yes.
Okay. Right. Thanks. So, so off-balance sheet items are like what I was telling is that which are of course will turn to on-balance sheet item down the line based on certain eventualities, which almost many a time it is certain. Like I mean LC, the moment documents are submitted, import documents are submitted by the presenting bank, you have the LC becoming a funded facility unless customer has fund in his account. So you need to debit somewhere when you are retiring the LC. So if the customer has funds, you will debit. Otherwise, you need to have import line facility. You will give a loan. So that becomes a funded facility, right? Then like the guarantee. So guarantee for various purposes you are giving, maybe bid bond, performance bond, various guarantees are there. Like credit guarantees, right? Now these guarantees are only undertaken by the bank. Those are undertaken by the bank, which is given. A beneficiary down the line at any point of time can claim the guarantee as per the guarantee terms. The moment a guarantee is claimed, I mean 99% of the time these guarantees are unconditional, non-revocable, irrevocable undertaken by the bank. So the moment beneficiary, for example, let us say you have a customer who is supplying, let us say, who is selling biscuits. So let's say that they have a guarantee from they have taken a guarantee from you to be issued to Ceylon Biscuits Limited. So they take let us say 10 million worth of guarantee from you, and then they have given to Ceylon Biscuits Limited. Now Ceylon Biscuits Limited is okay so far as this guy has given a credit guarantee from your bank. Let us say Bank of Ceylon you have given, and supplying the biscuits and all that, no problem. So now Ceylon Biscuits will see down the line, if this guy after the credit period, if he has not settled the money, he is postponing the payment, or his checks are returned, then they will claim the guarantee. The moment Ceylon Biscuits Limited claims the guarantee, you are supposed to honor the claim, right? There you can't say that you have supplied substandard biscuits, so you could not sell and all that. Those are out of your purview. That's you are not bothered about that. That's not what you are looking at. The customer requested a credit guarantee to be given to Ceylon Biscuits Limited, and then with some security arrangement or whatever, you have given a guarantee to Ceylon Biscuits, favoring Ceylon Biscuits on behalf of your customer, and Ceylon Biscuits is claiming you are supposed to pay. The moment you pay the claim, it becomes a funded facility where claimable from the customer. So that's how you differentiate on balance sheet, off balance sheet credit facilities. There are government departments also, they ask letter. Sometimes they call a facilitation letter to give a kind of a job when people are undertaking jobs. Let us say roadways, let us say some construction, let us say some electricity work. So these government departments call for people to bid for that. Now, sometimes they ask for some letters which are like, I'm telling that I'm having an account with the bank, and then I have a good relationship with the bank, and then if this particular contract is given, the customer has enough of facilities to meet with the expenses, something like that. Now we also will look at it, whether this is looking like whether it has an effect of a guarantee. If it has an effect of a guarantee, we will say it has to be a guarantee that, that normally it's an undertaking by the bank. Now, the moment you get the contract, you need to have the facilities with you. So it's kind of a guarantee what you are giving. If there is anything financial terms which makes the bank kind of liable down the line, we will make it a guarantee facility, make it a contingent liability. So the customer, sometimes we will be charging the customer a commission for that, right? Or some security arrangement also we will need that, that in case if the particular thing on that, if there's a claim or something comes, we will have to meet, so we need to have a security arrangement. So that is about the off-balance sheet items that we were discussing. So what do you understand by contingent liabilities, right? That includes, now we spoke about LC, we spoke about guarantees, the bonds also, like guarantees, right? So bonds, warranties, acceptances, letters of credit, and all that. So these are all off-balance sheet credit facilities, right? So we spoke about who is the borrower, individual, and then the companies, and then corporations, and all you call single companies. So joint stock companies, government of Sri Lanka, public corporation, statutory bodies, firms or associations of persons, right? Like there are many associations like Rotary Club or Lions Club or whatever. Okay, all of those things can be borrowers. Sorry to have quoted this name, the Rotary Club and Lions Club. Normally, that kind of welfare clubs and associations, we don't lend, right? We don't lend for the simple reason, if you take clubs and associations, these are all things which are like, they collect subscription from the members, and with that they do some social welfare projects and all that. I think why we won't go and lend to them under prudent credit policy is that they are office bearers. They are elected by the general membership every year, and they do some this one where they are not supposed to raise funds from banks to do things, right? They have to raise funds from the members or public, or sometimes they will have a musical show, or they will have a drama, or they will have a singing thing, or what, anything, and then they do, and then they raise the funds, and then or the sports event they will conduct. So somehow they will raise funds and use the funds, and then they will go and do a welfare project. So we are not supposed to go and lend to them to do their welfare projects, right? Because you can't hold people responsible. They will 1 year, they will go off. You can't hold them responsible to pay the loans, right? So that's about the clubs and associations, right? So we spoke about non-performing advances, So we looked at how do you segregate within NPL. How do you segregate, classify the non-performing advances within the broader category of non-performing advances. So there we looked at kind of if it is if a overdraft is in excess of the limit. Now normally when you're giving overdraft, let us say you are given a 10 million overdraft limit, people are supposed to operate the overdraft within limit, right? It can come to credit, it can be in debit, and then but then it should not be exceeding the limit. But if you find that overdraft is utilized above the approved limit, in excess of the limits, and then that remains in excess of the limit for over a period of 90 days continuously, right? So if it's more than 90 days, then that is a we call it special mention account, more than 90 days, right? Like the credit facilities, if the repayment arrangement is monthly, then 3 consecutive installments not paid means with the third one, that's about 90th day. 90th day it becomes special mention account. If there's kind of other things like you may have arrangement to pay quarterly or bullet payment and all that, it is from the point of due date. From the due date you will calculate 90 days, right? So that those are things which when it is exceeding the amount not paid, or excess not paid, or the installment capital and interest installment not paid from the due date for a period of 90 days, it becomes pushed into non-performing advances into special mention account category. So credit cards also the same, right? Minimum payment from the due date 90 days. People do already get 45 days of credit, right? So after 45 days of credit from the due date, another you are looking at 90 days. If up to 90 days also, the minimum payment, normally minimum payment is set by the banks at 5% of the outstanding, right? So if it is not paid, even the minimum payment is not paid, and if it is for a continuous period of 90 days which is due, then it becomes non-performing advance for credit card purposes. So credit card normally is a very risky product for the bank, for the simple reason that we are giving for people with less credit evaluation. Based on some criteria we give, so which has a higher possibility of becoming non-performing, right? That is the very reason the pricing is high, right? Normally for credit cards, banks now charge about 16%. We used to charge about 28% also. When it's overdue, we charge about 28%. Right? So in addition to the classification requirement for NPL set out above, banks shall classify performing loans as NPL. We have full recoverability in accordance with the agreed terms as in doubt. So this is a prudential requirement where you find, let us say that there's a customer to whom you have gone and lent in now he's 30 days overdue, but then you find that he is permanently incapacitated. Okay, he met with an accident. You don't wait till 90th day, right? You don't wait till 90th day because you know that it is not going to be paid now, right? Or it is going to be delayed. So you go and classify, right? So you don't, central bank is very particular on something where What kind of loans you will say? A new facility. You don't say a new facility where a facility which has been restructured, right? Or you grant a loan to settle another loan where the customer doesn't bring in good value funds, but then you grant another loan and then settle that. So those are not new loans, right? Should not be taken as new loan. That's what. So from the borrower for good value funds is that from the business proceeds, so from the job or whatever the fund has to come in to settle, right? So only when you are giving a facility which is not going and getting applied to settling of other existing facilities, which are called new loans. So this is something which we are discussing, which is very important, where if you are going in, rescheduling a facility, say, let us say a particular set of facilities, which has, looks like that the customer is not going to pay. Say you have 100 million facilities to given to a company. They have about overdraft, term loan, import loan, one set of. So this has become non-performing. Not become non-performing, let us say that the customer is not in a position to, for simplicity's sake, let us say you have given 100 million loan. The loan, you say that 60th day from the due date of an installment, it looks like that the customer cannot pay. So you go in, what you do, you restructure that. You extend the period. You make it the balance period available is 3 years. You make it 7 years. So you pay it over a period of 7 years, so that the installment will become smaller. So that with the current cash flow what you have, you can pay. So based on that, you are going in restructuring the facility and then giving a new loan. New loan in the sense you are giving another loan, extending the loan for 7 years period. Now, let us say after giving that second loan and settling the earlier one, from the due date of an installment, you don't wait for 90 days to classify that. Because earlier, before the you restructure, for 60 days, the customer did not pay. Now, the new loan, from the date of becoming due of an installment, if within 30 days if the customer doesn't settle, you are to classify that. Why? Because you have given a loan or you have restructured a particular loan facility because that was prone to be not paid. Customer was struggling to pay, that he due to something which has happened, he doesn't have cash flow and he may not pay. So you foresee that in 2 installments not paid, no point. So you go and restructure that. Now, after doing that, the first installment not paid for 30 days means you don't wait for 90 days to go and put it to NPA, but you will have to total before restructuring and after restructuring. What is the period? You total it up. Before restructuring, 60 days the customer did not pay. After restructuring also 30 days he did not pay. So altogether it is 90 days. Then 30 days after the due date of the restructuring or of the first installment becoming due, you will go and classify that. Right? That's important. So this is one important rule where you must keep in mind, like what I told you, if a customer has many facilities, let us say they may have overdraft, they may have term loans, they may have import demand loan, they may have packing credit loan, like pre-shipment loans, so housing loan, many loans they may have. So normally for a businessman or a company, you will have that kind of facilities. But if facilities, like out of the total facilities, if 30% or more of the value of the facility is becoming non-performing, then the entire set of facilities what you are given to the customer, you will have to classify that. So that's the central bank rule. Need to be very careful, because for example, let us say you have a term loan. For simplicity's sake, let us say you have a term loan in an overdraft facility. Now overdraft facility customer is you have given total of 40 million term loan and 60 million overdraft, and the customer, the 40 million term loan, let's say it has become classified because for over 90 days from the due date he has not paid. So the 40 million becomes NPA. When the 40 million becomes NPA, you have this balance 100 million. Let's say that's perfect. He's operating the account perfectly. Within limit, and then a lot of payments are coming. He's settling, he doesn't go beyond the limit, 60 million, no problem. But still for all, because this particular more than 30%, let's say 40 million facility, that has become non-performing. The customer entire 100 million will have to be non-performing. So that's a very important guideline by the central bank, which you should keep in mind. So central bank only allows you not to take the accrued interest, but capital you will have to look at. So we look at the SMA facilities, special mention credit facilities. So we say that, if the period is less than 180 days, more than 90 days, less than 180 days, normally overdraft, other credit facilities and all that, that is SMA, right? Credit cards, of course, basically only up to 120 days, not 180 days, 120 days. If it is paid within 120 days, then it is if it overdue for only within 120 days, those are called SMA, right? So we looked at, monthly or overdraft means more than 90 days, but less than 180 days. Other monthly installment loan facilities, anything which is also overdue for 90 days, 120 days. 180 days, I mean to say, 90 days, 180 days. And then other bullet loans, or or quarterly loans, or whatever, from the date of due date of a particular installment. If the dates are between overdue for more than 90 days but less than 180 days, those are called special mention. Then the next category we looked at, what is substandard credit facilities. So substandard is between the same way you calculate between 180 days to 360 days, right? 6 months to 1 year. But only for credit cards, which is basically if it is more than 180 days, more than 120 days but less than 180 days. In case of other loans, you saw that, it can go up to 1 year. That means 12 months. But then here in this case, of course, only up to 6 months. 4 months to 6 months. That is called substandard facilities. Then we looked at doubtful. So special mention, substandard, doubtful. What are doubtful? Doubtful are which is overdue more than 360 days, more than 1 year, but less than 18 months, right? 540 days. So similar way you will calculate. Only in case of credit cards, it's 240 days, for basically about 9 months. If it is less than 240 days, that's called doubtful credit, right? Minimum payment is now even though credit cards, this kind of classification given, and then we all are okay in providing for this according to the guideline, all right. But many banks do from the 90th day itself, they sometimes they write it off. I mean, write it down because credit cards are very risky products, like what I told you. Other credit facilities, of course, between 1 year to 540 days, then we call it doubtful credit facilities. So, right? So SMA down, substandard, and then doubtful. Then beyond 540 days, you call it loss, right? It's a loss. So you will have to consider as a loss. Beyond 540 days, you have to consider as loss, and you will have to write off. So I don't say you will have to write off, you will have to fully provide, right? You will have to fully provide. You will have to fully provide in your accounts. You will continue with the recovery actions, recovery, attempts what you are trying to do to recover the loan, but in your books, you will have to have full provision for that, right? So credit facilities like, normally monthly installment means more than 18 installments. That's what it's about, 1.5 years. More than 18 installments in overdue, that's loss. Credit cards more than 240 days overdue, all the banks will have to fully provide for it, fully make the provision. All right. So other credit facilities also, payment is in arrears for from the due date over 540 days. It's called loss. So you will have to fully provide for that. So you will reclassify non-performing advances, performing loans only and if only all the installments are cleared, right? Let us say there are about 3 or 4 installments or 8 installments overdue. If all the installments are cleared, only you can classify, reclassify, right? You can reclassify, right? So that is about the reclassifying. Let's say that it can be 3 installments overdue, 8 installments overdue, 10 installments overdue, whatever. You can reclassify if all the installments were paid by the customer, and you can make it performing. But in case of rescheduled loans, right? We do reschedule. Rescheduling is what? If a particular facility either when as a performing advance or as a non-performing advance, why we reschedule is that the current cash flow of the customer is not sufficient to pay the installments. So customer is finding it difficult. Let's say one of your housing loans you have given to a customer based on his previous income. This housing loan, he has to pay, make a payment of, let's say 40,000 a month. Capital plus interest, he'll have to pay 40,000 a month. So he was getting about 250,000 salary. He was getting a 250,000 salary, and he has to monthly 40,000 loan installment he has to meet. So he was paying perfectly okay. Now what happens is that Corona pandemic, due to that the company affected, and then this employer reduced the salary, cut the salary into half. Now he's getting only 125,000. So getting 125,000 with his expenses, he can't meet at 40,000 installment. Now he will come and say, I cannot meet the installment. Please help me and reschedule this. So let us say once the loan has gone into non-performing, if you are going and rescheduling, you will, let us say, the balance period for him to pay the loan is 5 years. You extend it up to 10 years so that you reduce the repayment capacity, reduce the installment what is required to pay into half or something. Right? So when you do that, if the loan was in the non-performing section, how do you do the reclassifying into performing. That is, if the loans after rescheduling, if it is paid basically regularly, then you will look at in which stage you went and did the reclassification, in the rescheduling. In which stage? That is what I mean. If when it was in the special mention category, you have gone and rescheduled the loan, then you will have to wait for 90 days after the first payment. You have to wait for 90 days after the first payment, then only you can bring it into performing. So if the facility was in the substandard section, then you went and rescheduled, then from the first payment of interest in the capital, first payment from the first installment, you have to wait for 180 days. Like that, if it is in the loss category, you went and rescheduled, you can't immediately take into your performing section. That from the first payment, you'll have to wait for 1 year, right? So this is how you can reclassify. This is very important because we go and do a rescheduling to, change, convert our non-performing into performing, right? But you can't convert non-performing into performing immediately. So you need to wait for a particular period based on where the loan was before you are rescheduling, right? That's the crux of the thing. Before you are rescheduling, if it is kind of in any of these stages, so for that period you have to wait before you make it a performing advance. Effect of that is that the interest and interest pay portion will not be taken into your profitability until such time, right? Until it becomes a classified, non-classified item. Any questions here? Anything you didn't understand?
Sir, excuse me. Sir, excuse me.
Yeah, please go ahead.
But some banks, when they do the loans after rescheduling the loans,
Yes.
they after 60 days only they make it as NPL, not 33.
See, this is a central bank guideline. This is the central bank guideline. So many of the banks have prudential practices. Like what I told you, for credit cards, I told you, after 90 days, you can make it a special mention account until 120 days. But many banks, what they do, they after 90 days itself, they will make a full provision, expecting that this loan will not be paid. Like that, many of the facilities also, the prudential practices, you can have a more stringent practice than what is mentioned by the central bank. But you can't go below that. You can have more stringent practice. So now let us say a facility which was in the special mention account, say 110 days or something like that, and then you go and reschedule it. So when you go and reschedule it from the first installment, you will have to wait for payment. You will have to wait for 90 days before you are taking into performing, right? Your case, I didn't understand. 60 days, what do you mean?
Not in this, the earlier one, you said that when if a loan, the client is getting trouble and in the bank makes the arrangement to reschedule the facility,
right?
After the rescheduling the facility, I mean, extending his repayment period,
right.
Prior to, by 30 days, normally it's 90 days we have to wait to classify as NPL, no?
Yes.
So it will be on 30 days we'll classify as NPL, whereas some banks are doing they are waiting till 60 days to classify as NPL?
Yeah, you see, if you are going in, rescheduling a facility which is already into NPA, you will have to wait for 90 days. That is the guideline. So you mean to say they are doing in for you to make it a performing, you will have to wait for 90 days. Do you mean to say that, I mean, in 60 days they are going and making it performing?
No, sir. It's that earlier part that when you said that when a performing customer, when a performing loan, if a customer get difficult to make it normal repayments, and then bank do the extend the period, no?
Yeah, extended period they do while the loan is in performing section or while the loan is in non-performing section?
While in the performing section.
While it is in the performing section, right?
Yeah.
Okay. Okay.
So now normally when a loan is in a performance section, it will take 90 days to get it NPA. But
Right.
you said now in this, it's been mentioned as once it being rescheduled, it will take 30 days to get NPA. Whereas some banks are giving 60 days to make it as NPA. No?
Excuse me. I think if a client is in out of order days performing say 30 days, and we are rescheduling, then we can't have that maximum tenor allowed in the central bank. We have to at least 30 days out of order days plus whatever the out of order days to classify as an NPA. So that is not only 30 days, in any other out of order days, if we reschedule, we have to take that out of order days in the account.
Yeah, now, that's what earlier we looked at. Now, let us say a loan was not paid for 30 days, like what you say, not paid for 30 days from the due date, and then you go and do the reschedulement of that. And then after the reschedulement, of course, if from the first installment for 60 days, if it is not paid, so previously it was 30 days, currently it is 60 days, it totals up to 90 days. Then you will have to make it NPA. That is the central bank rule, right? So previous one and then current one, you total it up and see whether it is exceeding 90 days. So if it is exceeding 90 days, you will have to make it NPA. That is the central bank rule. So the banks only will have to have more stringent practices than this, so follow this practice. They can't have more relaxed practice than this. So this is what we looked at earlier. Previously in a slide I showed you. This is what I say. When rescheduling occurs before a credit facility is classified as NPL, the rescheduled credit facility shall be classified as non-performing when in aggregate the period of time the credit facility was in arrears before rescheduling. That is, in that case, 30 days before rescheduling, 30 days it was overdue. And after rescheduling from the first installment, another 60 days, that makes 90 days. Then it is NPA. That's what we looked at earlier. This is the central bank's precise guideline. Are you clear?
Yeah, that's right. So what I understood was earlier that after 30 days it will classify as NPL. That's why.
No. It depends. Let us say at the point of you going and restructuring, it is 45 days overdue. It is 45 days overdue, and then you went and did the restructuring. Now what happens is that after paying the after reschedulement, consider 2-3 things. Number one, the loan was a performing advance. It was not non-performing, it was performing. It was overdue for 45 days. You went and did the restructuring at that point. Now, after restructuring, the first installment, from the first installment, let us say you find the loan not paid for 45 days. If the loan not paid for 45 days, you will calculate the before restructuring 45 days, after restructuring, and then from the first installment another 45 days, that makes up 90 days. So at the 45th day, you will have to go and make it an NPA. So you don't wait for 90 days for that. That's what I said earlier. This is the precise guideline.
Okay, sir, understood. Thank you.
Right. Thanks. So there are requirements of the provision requirements. Of course, there are two types of provision requirements are there. One is general provision, the other one is specific provision. So general provision is basically on the advanced portfolio, you will have to have a provision, right? On your performing advances, on the portfolio performing advances, you will have a general provision. So this time to time it changes. 1% as of the date, right? Okay. Now I hope it is 0.5%. Anyone knows about this? What is the current general provision requirement? Current general provision requirement must be 0.5%. Okay, I will look at it and then during the break I will update you. Right. The other one is specific provision. Now, specific provision only we will have to look at, depending on the different stages a facility in a loan is in, how much of provision to be made. So normally in the
excuse me, sir. Presently, we are going with this impairment and central bank provisions only for reporting purpose. For impairment only we practice, I think.
Yeah, impairment provisions are like based on the Basel IFRS 9. That's reporting standards. So your bank will prepare 2-3 sets of accounts. One set of accounts for central bank, one set of accounts for reporting requirements in declaration, another set of accounts for tax purposes. Why? Because central banks, you need to have the provision as per the central bank's regulations. So for that, you need to calculate based on that. You will be making provisions, general provisions. Then impairment provisions you should have. Then taxes you will have to pay according to the, there may be so many expenses which are allowable, so many expenses which are not allowed according to tax laws. Based on that, your profit has to be adjusted, and then on that you will have to pay the taxes. Right? For a simple example to tell you is that how the taxes to be looked at, how your bank will look at the taxes is that let me show on the board some figures.
Sir.
Yes.
Sir, is that legal to maintain two books for provisioning and taxes? Is it valid?
I didn't get you.
Is it possible to maintain two books for that, as you mentioned, for that taxes and provisioning kind of thing? Is it valid for institute?
Yeah, that's the way it has to be. That's all. That's valid because tax department now. Let us say you have a profit of say you are showing a profit of 1 billion. 1 billion. Your institution shows a profit of 1 billion. Straightforward. Let us say banks are to pay 28% now. 28% or 24% now. 28%. You don't just go and calculate 1 billion of that 24%. So you are going to pay 240 million taxes. It doesn't work that way. You will have to adjust your profit to for the tax purposes as per the tax law. So as per the tax law, you will have to recalculate. I don't say it's a you maintain separate set of accounts. It is you will have to, your profit figure has to be reworked as per the tax law. Like that, for central bank purposes, provision has to be based on their laws of the provisioning. But for reporting, you need to have this IFRS 9 based impairment provisions done in this. So this is legal. Can't help it. So that's what, if you go and check with your company, they will tell you this what is being done. Okay, let me put it on the board for you. Let's say that you have your profit and loss account. You have a profit of in your profit of and loss account, you have profit of 1 billion. But in your profit and loss account, arriving at 1 billion, for example, let us say you have advertisements, you have advertisements, you have 100 million, they charge 100 million. Let's say staff, executive in entertainment. Executive entertainment, let us say, they charge 200 million. For example, right? So your advertisement 100 million, executive entertainment 200 million. Now the tax law time to time changes. Let us presume here, tax law says that advertisement expenses are not allowed. They will say this is not allowed. Right? And this is not allowed. Now, executive in entertainment, let us say 50% allowed. These are the regulations in the tax law. I don't say this is the exact thing, but time to time the tax law changes, right? That you should understand. Time to time it changes, and then they bring in so many regulations in the tax law. Now let us say they say during this year, presume it may, it changes, but let us presume that this is a presumption, right? Presumption. They say advertisement expenses not allowed. Entertainment expenses for executives, only 50% can be allowed. Now, presuming that only these two items are there, how this tax law, like what I told you, on a profit 1 billion, say we have to pay 24% corporate tax, it will be 240 million. But the Inland Road Department will not accept it. They will say you will have to adjust for all this. So how do you adjust it? They say, how do you adjust it? This is the net profit, right? 1 billion. Now they say advertisement expenses not allowed. Add advertisement expenses. Charge to P&L is 100 million. Right? And then let us say executive entertainment, right? Executive entertainment. Executive entertainment, 50% of 200 million. That is 100 million. So for tax purposes, the profit is profit for tax purposes. Profit for tax purposes. It will be 1.2 billion. So instead of straightforward 240 million earlier we calculated, you will have to calculate your 24%. Let us say the corporate tax is 24% as a presumption. 24% is the corporate tax. The tax has to be paid on 1.2 billion. So now, when you calculate on 1.2 billion, how much? You will pay. So taxes at 24%, corporate taxes, 288 million you will have to pay. Straightforward, if you had calculated here, it may be 240 million. But because of the disallowable expenses, these are called disallowable, this much disallowed, not allowed. So this is how your accounts will change for tax purposes. So central bank purposes, you have to make the provisions. But for reporting IFRS line based thing, you will have to have impairment provisions done. These are the different changes in your accounts which will take place. You may not know, your accounts department will know. Right? Are you clear? Are you okay? Or anyone did not understand? Can you hear me?
Yes, we can hear.
Right. Okay. So normally in calculating the general provision requirement, general provision providing on the total performing advances, the cash back facilities, because it's 100% cash back, and then facilities given against gold, government securities, and all will be deducted because these are near cash securities, right? Cash immediately can be settled. Gold also can be sold off and then settled, and then government securities also can be turned into cash, so that the facilities against those securities will be deducted from that in order to make the provision. So the specific provisions, right, we are to make is that there is a we found a few categories, whether SMA, whether it is substandard, whether it is doubtful, whether it is loss, right? 4 categories under NPA we looked at. So under SMA, special mention account, you only will suspend the interest. You will not take the interest from the the first installment. I mean, from the point that installment is not paid, the 90 days and thereafter, you will not take the interest into your profit and loss account. Interest has to be suspended. It will be suspended. It will be in a suspense account. It will be so. That's what under SMA will happen. But over and above the SMA, over and above suspending the interest, if it is into the substandard category, you will have to have a 20% provision. For all the other facilities, you will have a 20% provision. And credit cards, you will have a 25% provision, right? You'll have 25% provision. Like what I told you, many banks will provide 100% provision for credit cards, right? That is a prudential, practice by the banks, thinking that these are risky product. But central bank requirement is that 25% provision should be made for credit cards, which is in the substandard section, right? We will come back to the haircut thing, right? Out of this 20%, how do you calculate this 20%? That we will come back, right? Then the doubtful, if it is doubtful, if it is going into more than 1 year, less than 1.5 years, doubtful means 50% provision required. If it is a loss category, we are more than 18 months overdue. And when it comes to a credit card, more than 180 days overdue, that's loss, the entire amount has to be provided for in the accounts. The specific provision has to be 100%. Now, in all these cases, whether substandard or doubtful or loss category, you have this haircut rule. So your haircut rule is that how much of percentage you can reduce from the asset, non-performing asset, to make the provision, right? So this is by the central bank divided into two, which is a freehold property and leasehold property. So if it's a freehold property, right, at the time when you are first providing, right, when you are first providing, you will take 75% of the forced sale value, right? You will take the 75% of the forced sale value. For example, you have a 100 million loan in the, let's say, substandard. Substandard, under the substandard is you need to have a 20% provision, right? You need to have a 20% provision. If it is unsecured, you will provide 20 million, because 100 million is the facility. You need to provide 20 million. 20 million you will have to debit your P&L and then keep 20 million for this particular facility, right? Now, let's say you have a property taken as security, right, which has a value of, let's say, 120 million for sale value. You have for sale value 120 million you have taken as security. Now, what you will do, your loan is 100 million. Now, 120 million for sale value of that 75% is how much? 90 million, right? 90 million. So what you will do, 100 million minus 90 million, that's what you deduct. So balance unsecured exposure is 10 million. Of that you will provide for 2 million. So the difference between unsecured loan and secured loan is that if it is covered 100 million facility covered with property mortgage with a for sale value of 120 million, when you have that, you are only providing 2 million when the facility is in the substandard section, whereas if it is unsecured, you will be providing 20 million, right? So that's the comfort you have. Now let us say so if it is in this in the loss section, right? If it is in the loss section, what you will do? there are stages, how much you will take into account. Up to the point it goes into loss section, I mean, you are able to keep the 75%, you can deduct and do this one. So for the same facility, like what I told you, 100 million, you are first time when it is in substandard, you are going and providing 20%. When it's in the doubtful, what you will do, balance unsecured, you have 10 million, out of that you will have to provide 50%. That means another 3 million you will provide, right? That is 5 million total. And if it is into the loss section, you will go and provide for the 10 million. That is the unsecured exposure. Because for sale value, you have 75% of the for sale value, you have 90 million. So balance 10 million only you are providing. So balance completely you will provide 10 million when the facility is overdue for more than or up to 12 months, up to 18 months, which is the loss category. So up to that, you are, I mean, with 10 million you will escape, right? 10 million provision, because the particular property is with a for sale value of 120 million. Keep something in mind. Even if the property is 75% of the for sale value, you can take it to deduct for the provision requirements. That valuation should have been there, like what I told you, which is valid for 3 years, right? Every 3 years or so, it has to be again reviewed. It should be reviewed. If it is not reviewed, then you are supposed to provide for the entire amount, right? So the particular property should have been reviewed. Confirmation on the valuation should be there, right? So the point where it has become a loss, right, past 540 days, right, past after the 540 days, you can hold on to this particular until for another 1 year, right? That means 1.5 years to 2.5 years. Until about 2.5 years, you can maintain this for sale value of 75%. But if it is more than 1 year after loss, in the loss section, becomes for the next 1 year, you can only take 60% of that, right? Like that, progressively, when it is more than 24 months from the point it has got into loss section, up to 36, it is 50%. You can take 50%. More than 36, but less than 48 months, it is 40% you can take. So you can take 40%. That is the last, but more than 48 months. That means for your facility overdue for 18 months, from that another 48 months, another 4 years. So 18 months means 1.5 years. Another 4 years, 5.5 years. After 5.5 years, the property should be reviewed and on a regular basis, and then the bank can make further discounts. Now, what do you mean by this percentage? Now, let us say your facility of this 100 million with a for sale value of 120 million property you have, and which is not paid for, it's in the loss section for 3 years, right? Less than 48 months, but not exceeding 4 years in the loss section. If it is so, here the guideline is 40%. That means what? You can, we told you, we looked at 120 million is the for sale value. Out of that, if you take the 40%, that means 48 million. So 48 million is the amount you can, that's the haircut, that's the amount you can deduct. That means 100 million is your non-performing, let us say, minus 48. So for the balance 52, you will provide, right? Balance 52, you will fully provide. So 52 million you should have been provided by that time. That's what it means. If it is unsecured, you would have already made a provision. If the particular security not reviewed means, then you would have paid 100 million. You would have already provided 100 million. So this percentage will vary between the freehold property and leasehold property. So if it is a leasehold property, there the percentages are like little lower than what the percentage you will take for a freehold property. So leasehold property in place of 75% for at the first time provisioning, it is 60% only you will take. So it will 60%, 60%, 50%, 40%, for 30%, like that it will reduce. And if it is more than 3 years, less than 48 months, you are taking only 30% in the loss category. Then leasehold properties are like, for a period, right? It is for a period only. So you have a risk. You can't eternally, you can't hold on to that. Say somebody has a 30-year lease, now 20 years gone. There's only 10 years left, right? So only 10 years. So the bank's ability to sort of, take it and then give it to somebody is much, much less. These rights to be given to somebody, percentage, the possibility is much less, right? I would say here, central bank also is a bit generous in that regard, because leasehold properties are, less attractive compared to freehold properties. Any questions here for you? This is something you need to understand clearly if you are in credit. Right? Any questions? Are you okay? Yeah, go ahead and tell me.
Yes, sir.
Okay. All right. Thanks. So you need to take valuation reports for the assets that you are taking. Say if the facilities are more than 5 million or 0.1% of the capital of the bank or the institution, whichever is less, professional external valuation is necessary, right? That's the central bank's regulations. So if you are granting home loans, this is what we had been discussing. If you are granting home loans, the valuation report is valid only for 4 years. And any other purposes, for commercial purposes and all that, if you have taken a mortgage, then the valuation is valid for 3 years. So for less than 5 million facilities, of course, somebody independent office of the bank can do the valuation. So that valuation can be valid for 2 years. This is the central bank's guideline on the valuation of the assets, properties, what you are taking as security. So an external independent valuer, that also the criteria prescribed by the central bank. Can be a chartered valuation surveyor, a fellow of the Institute of Valuers of Sri Lanka for 5 years, graduate member of 5 years for 10 years, or an associate member of the, people can, even without the qualification, they over a period of time they will practice, and then they will become an associate member. They will get membership and then get member. If they have more than 20 years of experience, they can be external independent valuer for the bank. So the other things also you must keep in mind if you are taking any other securities. If you are taking a mortgage one, which is acceptable, if the primary mortgage also with you. If you are taking a secondary mortgage bond, it cannot be taken for this calculation, right? Secondary mortgage bond where the primary is elsewhere, right? Let us say some bank, HNB is having the primary mortgage bond, and Ceylon is taking the secondary mortgage bond. That you can't take it for this particular calculation, right? You can't take it. It goes almost for this provision calculation, it will be unsecured like.
Excuse me, sir.
Yes.
In the case of primary mortgage bond cancelled by the particular bank,
Yes.
and secondary and tertiary quaternary mortgage bonds executed by the same bank, it is valid?
Yeah. Something very important, keep in mind. Say, let us say you have primary, secondary, tertiary, quaternary mortgage bonds executed on a particular property, where if the primary mortgage bond now under this definition, if you have subsequent mortgages also with the same bank, those all that can be taken into account, right? Your mortgages are valid for you because you are going to take the property valuation as a for sale value calculation. You are not looking at the for your haircut thing. You are looking at the for sale value of the property. For sale value of the property for haircut rule, you cannot take if the property is mortgaged elsewhere. That's the only thing. Now, if you have primary, secondary, tertiary, and all with the same bank, if you have the primary mortgage bond cancelled, now keep in mind, in the land registry, you go and register the mortgages in the order. And what happens is that if the primary mortgage bond is cancelled, the secondary mortgage will take the position of primary. Secondary, for all purposes, the secondary mortgage will be considered as the primary mortgage bond. So that's a very important thing we must keep in mind. And if it is with the same bank, that can be taken into account. And for haircut rule, you can take the for sale value. No problem. Okay.
Okay, sir. Thank you.
The other thing is that what we looked at is that the title deed, when people are depositing title deed, they say that, you keep the deed. Now, with a lot of money lenders do this. Informal money lenders in the market, you see that, somebody going and asking for a loan from them, they will take, bring your house deed. They will keep it with them. And then sometimes, they execute a transfer thing and then transfer deed and all that also, they will keep a draft and then get them signed and go and register. That kind of lot of things have been done by the private money lenders. Right? People, if the loan is not settled, they will get the property transferred also. Now, that is outside the banking. Now, title deed, when people come and say that, okay, you keep the title deed and process a loan, that's an unsecured loan. Because keeping a title deed means nothing to the bank. If you have a mortgage, okay. Registered mortgage, okay. If you don't have registered mortgage, no point in keeping a title deed with you. It's only a matter the customer doesn't have the title deed with him, because if he wants to do a transfer, he needs the title deed. The lawyer will ask for the title deed. That's all. Bank, it has no value. So that cannot be taken for these purposes of any value. Many of the instances we have come across, we do come across in the market also. There are people who are executing, bogus title deeds also and then keep. So this is a problem. The land registry issues are a problem. Like, a lot of fraudsters around. When I was working in Bangladesh, during those days, the bank used to do lending, keeping this, deposit of title deeds. They say deposit of title deeds with the bank and all that. So one of those title deeds we have, and then we were trying to sort of put a civil case and then say on that, and then people, 3-4 people came, and then they are also showing deeds of the particular property. We are the owners, we are the owners, we are the owners, like. So, you know, many countries have this land registry and then property registration problems are there. So that's a very sticky issue. Even in Sri Lanka, we have this problem. Where the land registry records are sometimes maneuvered. So people, you know, maintain a couple of, that's why the title checking, execution of mortgages and all that has to be done very carefully. Okay, that's about the properties. Then the life insurance policies, basically we look at the 90% of the surrender value. The surrender value is that if you are taking a life insurance policy, at the point we are taking a surrender value certificate from the insurance company, they will give a surrender value. That means even if the policy premiums are not paid, at any point of time the bank claims, they will, if the life insurance policy is assigned to the bank, so the customer will have to assign it to the bank. Customers with the customer's consent letter, we will give it to the insurance company. Insurance company will assign. We will have confirmation from them that this particular policy is assigned to the bank. So once it is assigned to the bank, at any point of time, if you want to claim on that particular insurance policy, we will ask for the surrender value to be paid. Surrender value will increase every year. So we can get the latest surrender value certificate and then we can claim on that, right? 90%. So 90% of the surrender value is the value we can take as a realizable value of the other security for this particular provision purposes. Gold, of course, market value, right? Subject to insurance, gold market value. Shares, if it's a quoted and trading, that is any shares which are quoted in the Colombo Stock Exchange. It has to be quoted. That means it can be, it has a market value, right? You have a market value of the shares readily acceptable because that's trading in the market. So 90% of the market value can be taken for this particular realizable value calculation. If there are no trading, right, there are many companies which due to various reasons, primarily for not submitting the accounts on time, their trading is suspended, right? The Colombo Stock Exchange, Securities and Exchange Commission, they suspend the trading of that particular security share. So if it is so, if it is not traded, then audited accounts, based on the audited accounts, right? If trading suspended, then audited accounts, the audited accounts, net realizable tangible asset value, right? Asset value of the shares. You get from that what is the book value per share. Book value per share for the number of shares we will calculate, and that we can take into account here. If it is unquoted, you can take 75% of the net tangible asset value. That also from the accounts we can take the book value, right? Net book value, 75% of that. So this should be certified by the company auditors because we independently we can't verify that. So the auditors will have to certify that valuation we can take. So if you have taken mortgage over plant, machinery, equipment and all that, there of course, there will be a straight line depreciation applicable. So from the cost of acquisition, from the cost of purchase, 20% straight line method depreciation should be there. So that means over a period of 5 years, the particular plant or machinery has to be written off. So based on that, in whichever, let us say we are looking at a 4th year of the asset, that means only 20% will be balance, or up to Fourth year means maybe 40% will be balanced. Right, 3 years we would have written off 60%, depreciated of 60%, balance 40% will be there. Fifth year means only 20%. Right, I mean that portion can be taken. Motor vehicles also straight line in 4 years to be amortized, right? So that balance valuation can be taken. Say at that end of second year means 50% can be there. So that is the value we will take as the net realizable value. Not like in Sri Lankan market where we have you know, like, I mean, value vehicle 10-year-old, 12-year-old vehicles, you know, still having some value. That will not be taken into account in your realizable value calculation. So if you have the pledge over stocks and goods under the bank control, this is something which never happens now. Previous days, what happens is that the stocks has to be kept in the warehouse. The warehouse has to be under the control of the bank, joint control of the bank and the customer. Bank will have a key, customer will have a key. If the customer wants to take the stocks, part of the stocks to sell, the bank officer will go, customer's representative will come, they will open, they will take it. By the time the customer for the old one, they should have deposited the money. But he had taken already, that should have come to the turnover. So that kind of a control. Now that of course now now hardly happens. So if that is there, if the bank has control over the stocks and goods of the customer, then of course 50% of the market value based on the case by cases, it can be taken for as the realizable value. Hypothecation of stocks. Stocks are hypothecated to the bank, 30% of the market value. Right. Then debentures quoted debentures, 90% of the latest market value, right? So sometimes customer would have gone and invested in some debentures, and then that you would have taken as security for your lending. Let us say some DFCC bank issued some debentures, and then that the customer has some debentures worth about 10 million, and then he has come and given that you can keep those debentures in the slash account in the common names of the customer as well as the bank, and that is the security. Or if that is the security, then 90% of the latest market price of the particular debentures can be taken as realizable value for these calculations. When it comes to guarantees, if you take guarantees, many a time guarantee is like, you take a standby guarantee, standby LC we call it, standby LC, which is a guarantee, basically a guarantee from another bank, right? Maybe an overseas bank, maybe a local bank. They give a guarantee based on that we lend to the customer. So for example, let us say a foreign company is coming in, incorporating, and then they are doing business here. So they are asking you 100 million facility. If they ask 100 million facility, you say you are a company, you are coming from an overseas country, we don't know about you, right? We don't know whether you can be trusted or not. So we can't give you facility, 100 million we can't give you. Then the bank asks you, how can you help? How can you help you? Because we want working capital facility, because our money will come only once in a month or once in 3 months or something. So until then we won't working capital facility. Then you will tell him, okay, from your country, from a bank acceptable to us, you give us a guarantee, bank guarantee, give a guarantee, bank guarantee for 2 years or 3 years for the period you want overdraft. That is acceptable for us to lend to you. So he will go and apply from their home country, and then they will ask from there. They will take a standby. That means that means a guarantee. We call it by way of standby LC comes. We call it standby LC, which is basically a guarantee. So they give a guarantee. So but the comfort given to your bank is that from that guarantee, anytime if this overseas customer, if he doesn't settle, you will call them, ask them to honor. Right, on the guarantee, they will have to make the payment. So that kind of guarantee, if you are taken from licensed banks in corporate locally or outside, taking, you look at their credit rating. So if their credit rating is AAA to AA minus or equivalent, now this has to be different credit rating agencies will have different ways of this one. So there is a mapping. So based on that, if it is equivalent to these AAA to AA minus or equivalent, 80% of that particular credit guarantee you can take as the realizable value. If it is less A plus to A minus or equivalent, 50% you can take. There are any government guarantees. Now, treasury guarantees are given for government departments to borrow from different banks, private or public or your bank. The government guarantees, of course, 100% realizable value. You give 100% realizable value. So the bank's write down, provisioning policy should be based on this realizable value. Any questions up to now? Any questions? So we have fully looked at how the classification being done, right? So what is your own balance sheet facilities? What is your balance sheet facilities? What is who is a borrower? Who is a performing advance? What is a non-performing advance? And under the non-performing advance, what are the classifications available under the non-performing advance, including credit card and other loans, depending on the period of repayment. And how do you, based on the risk, how do you classify a customer as non-performing advance, right? And then how do you reschedule a facility? And while rescheduling, how do you calculate the period under which period for your calculation of NPA, right? Then we looked at if you are giving multiple credit facility to a single borrower, under what circumstances you will go and place him as a non-performing customer. If there are a composite of facilities, you have given many facilities. What is this one? So there we looked at that. 30% of the credit facilities, total credit facilities, if it is becoming NPA, the entire amount has to be NPA, right? Then we looked at the classification within NPA. Yeah, special mention account, substandard, doubtful, loss categories we looked at. Then we looked at how do you reclassify? What are the important points under the reclassification? And when you are restructuring a facility in different stages under NPA, how do you take it to performing section? What is the period you need to consider to take into performing section? We looked at the general provisions, specific provision, and specific provision percentages you looked at. Like what is the percentage of specific provision? You looked at the haircut rule by the central bank based on at which point you have the particular facility in the non-performing advance. Based on that, how do you apply the haircut rule of your asset, immovable property, whether it is freehold or leasehold you looked at, and so why valuation report is required, what is the guideline by the central bank on taking the valuation reports, so what is the criteria, and then who can be external valuer, and realizable value of all the other securities what you will consider, right? Anything which is not mentioned here you will be 100% providing, right? So realizable value of different securities we looked at, and until guarantees, foreign guarantees or local guarantees, local bank guarantees also we looked at. So comprehensively we have covered on these areas. Any question? Any questions? Are you all okay? Are you all comfortable?
Yes, sir.
Right, great. So go for a break. We will meet at 10:50. 10:50 we will meet up again, and we probably will go to the almost the last section of this lecture. I will go into that, but we do have question paper to discuss. If possible, I will discuss this week. For the coming weeks, I will discuss, and then whatever which is left out, which I said I will cover in the coming weeks. And have you all submitted the assignments? Have you all completed? Anyone who has not done? Can I start marking? If all of you have done the assignments, I can take and I can see that I mark it within a week's time and complete that task. So are you all comfortable with that?
Yes, sir.
Right.
Yes,
Hope all of you have done complete. I will start marking, and probably after that, of course, I may not be able to go back to the same thing. I may not be marking things which are coming after that. Now that I said 15th of Jan, now today 24th of Jan. So you had enough of time, I hope. So hope you will not ask for more time beyond this. I will start marking that. Then of course, hereafter, maybe a session more we will have on rest of the area. Maybe one session or two sessions we will look at. We will discuss question papers. Right, okay, have a break, come at 10:55. Let's now look at monitoring and recovery procedures. So as you know, as far as a bank or financial institution is concerned, the loan portfolio is a lifeline. Loan portfolio is a lifeline that decides what is the institution, how does it do its affairs, and then its reputation, its brand name, everything is depending on the, I would say, is on the quality of the loan portfolio, right? The quality of the loan portfolio can get affected by various factors. So some of the factors are like, the reputation. Say if a financial institution is found going and investing into very risky proposals, risky things when they are doing, there's a reputation, like, okay, maybe their risk appetite is much more, and then that gives a lot of signals to the market. Okay, their risk is high, and then investors will be thinking, the stakeholders will be thinking, oh God, will there be a problem for the balance sheet in the future, in the continuity of the institution? looks like, I mean, they are not prudentially managing. So where they are going in, putting their assets, it looks like a little bit more riskier, and then it can turn into bad, and then the company can fall into trouble, right? So reputation, right? So the quality of the loan portfolio can affect the reputation of the institution. The market standing in the market, how the particular institution is perceived, right? So some banks are perceived as very solid bank, and they have they balance with their risk and returns properly, and then so that they don't get into unnecessary trouble, and they safeguard the stakeholder interest to the maximum. Like, what is the market standing, right? And profits is very important for an institution. We can't say we only will lend to very safe things and then cash or next to cash, and so that, I mean, our non-performing portfolio is almost nil, and then we are very good lender, but the profits are much less, right? Because of our prudential practices, as we are doing it overdoing it, so the profits are less. Then it's a problem. So you need to have a profit also. You need to show year-on-year growth on profitability also, with all the issues. The regulatory requirements, right? In the quality of the portfolio can increase. The regulatory requirement, I mean, your provision requirements and all that, I mean, you can increase. Impairment provision requirements, kind of things, it can increase, and which can affect the your overall picture, right? Your capital adequacy will increase based on the quality of the portfolio. If the portfolio quality is low, then your capital requirement is high, because the weighted average, when you are calculating, it will be higher. Weighted average lending for various purposes of under Basel II and under Basel III, under the credit risk, when you are doing the capital allocation. Capital allocation can be high because of the quality of the loan portfolio. So which are so many areas where the quality of your loan portfolio can affect. So like what I told you, this is one of the reasons why, or the primary reason why, many of the finance companies were failing. They are good at sort of advertising and then bringing celebrities, and then creating a market perception, and then getting depositors to deposit, giving high returns and all that. But where the problem comes is that where they are going in parking their assets. So where they are going in, what kind of customers they get, where they are going in investing. That's where the problem. So when there's a problem, that pulls down the whole institution. So the quality is decided. So how will you say it's the very good quality? Their loan portfolio quality is very high. So a few of them are like, NPA low, very low, right? But kind of a sectoral exposure, right? So if somebody says that, you have 50% exposure to condominium properties, not a good portfolio. You can't go and expose half of your portfolio to condominium properties, because it has its own risk parameters. And looking at the security cover, right? How much of the loan portfolio is covered by good securities? So if you have a good coverage under the security, then like what we saw a little while ago, you don't have to have provision. Your provision can be less, right? In times of issues, you will be able to realize your assets and then cover loans. Then the provision cover. This is a very popular parameter by the investors, the foreign investors who are looking at investing in your bank. They will look at what is the provision cover. So their portfolio, their NPA is so much. So they have an NPA of 10 billion. Their provision cover is 6 billion. It gives comfort to them. Say 60% of the portfolio, they have provision cover. So when you look at the provision cover and the security, realizable security and all that, almost the non-performing portfolio is covered. So the institution is solid, right? So provision cover is one of the important criteria which has been looked at by the stakeholders. So like what we were looking at from the beginning, we were looking at credit and credit culture, credit policy, and then what does credit policy says, what is the credit culture of the particular institution. We have been talking on this a lot. So the credit failure, you can't say that this has happened overnight. Yesterday he was performing well, today he went bad. It's not that. A credit failure of a customer is a result of a long-term process. It's not an event. It's not an event which has happened. There are few that say, let's say the business went under fire, but the customer has not taken the fire policy, let us say. Something like that. It can happen like that. But then 99% of the time, credit failure happens as a long-term process. It's not an event. Many customers, in your corporate customers also, you will see, because the banks are undercutting each other and then trying to lend to a few names which are available in the market. What they do is that many customers, they will have limits with every bank and then borrow from one bank and settle in another bank. That type of, in a way, unfortunately, banks have accommodated this. This is happening in the market. The customers are getting the best of it. Very, very risky. Because when the customer from the business, without bringing good value funds and then without settling the loan, when the customers go around establishing limits in many banks, where banks without considering how much of the business he has, how much of stocks he has, how much of assets he has, how much of turnover he has, whether it is for the turnover, whether he is having the facility, without considering that, people just simply the other bank is giving, that bank is good, they are giving, this bank is giving, they also establish that kind of limits. Customers very easily negotiate the rates and then keep on utilizing the limits and then transferring funds from one bank to the other. So the risk is that when that customer fails, the entire banking, all the banks fall into trouble because of the customer. Because at one point of time he gets stuck and then he is not able to roll over. One bank is putting a block there, let us say, then this rolling over will stop. Then is the problem of that not having a proper business, not generating turnover, not bringing in good value funds, all will come in effect. At that point, all of the banks, when they are having lending against stocks and book debts and all that, which are of namesake securities, normally banks don't really go and check all those things. Banks fall into trouble. So the credit failure is a long-term process. What kind of a thing now? Truly speaking, in a branch, if you are lending, you have to go and see once in 3 months, go and see the customer stocks and all that. So if you are lending against stocks and book debts, whether the security, the mortgage or stocks and book debts, whether that value is within the value, whether the customer has more value than that, ensure whether the turnover is there in the account, right? Whether the customer business turnover is going through the account, and then whether the turnover supports the limits what you established. All that you will have to look at. So the inability, if you haven't done that, or inability for the customer to show that, is where the problem, which can eventually lead to the facility becoming non-performing. So the credit failures in that case can be anticipated. We can see that. I mean, that's the art of a lending officer. Lending officer can look at a particular customer, how he behaves, how his account is behaving, how his stocks and kind of things are there, how he's faring in the market. Looking at few of the signals, lending officer can know in which direction this business is going. So where to put the brakes, all that he should know. He can understand, he can do that. So credit failures can be anticipated and avoided by the careful observation and analysis and timely actions. Timely actions is very important. Most of the time in an NPA, if you go and see, if you really look at in your institution also non-performing advances, most of the time what happens is that we are late. We are late to understand that customer is going into difficulties. We are late to understand, we are late to arrest the situation, we are late to educate the customer, stop him, and by the time we come to know, customer is already into a deep pit, and you can't rescue the customer. Then we go on to recovery actions. So taking actions against the customer is not the pleasant thing to do, but still for all, that's what we are supposed to do, we will do. But if we had identified the problems early, and then if we had discussed with the customer, if we had put brakes on him, for example, when share market is going up, let us say you have a car dealer in your account, in your portfolio, a car dealer to whom you have given a line of facilities. Let's say you have a overdraft facility of 100 million, and you find that there are imports taking place. The overdraft facility currently you may not need for the particular facility. If you had spoken and then reduced that, okay. If you just allowed it, let us say the customer sees there's overdraft facility, I have no vehicle to import and use the facility. Now he says share market is booming. So some shares which were trading at 130 rupees, let us say it has gone to 700 rupees. He feels that these shares keep on going up. I will go and use my 100 million overdraft and then put into the shares. This is what many people are doing now. They put it. Let's say that 700, 800 shares, now it is pumped and then now it is coming back to 100, 150. What will happen? Almost 80-90% of the 100 million would have gone. Right? This happens. Even as I speak, that happens in the market. People are investing now. People are thinking that, I mean, my market is really up and then it's going to perform really well, but you never know. You never know. There are so many instances in the past also, it has happened that way. So unless we identify now, if someone, a car dealer who is having a limit and then he doesn't have, import thing or whatever, it's rather better to speak to him and then freeze that limits, right? And if he wants to invest in share market, it has to be done in a separate evaluation. Separate evaluation has to be done and then a limit to be allowed rather than allowing them to use this limit. So those are kind of, this is where we are going to see the early warning signals. This has to be done by the lending officers. They will have to safeguard the loan portfolio. So what are the symptoms? What are the symptoms? Based on that, you will go and diagnose potential credit risk, right? Potential credit failures. Very important things are deterioration of financial affairs, right? Turnover coming down. The first thing what you will notice that the turnover, credit turnover in the account is coming down. You find hardcore forming. You find there is no fluctuation in the account where overdraft is obtained. You find there is the loans are not being paid on time. There is delay. You find customer is not answering the phone, and you call the office. Office staff also keep on telling that boss is not there, boss is at a meeting, boss will come late, here he is overseas. So many excuses. Unlike earlier, you are not able to contact the boss. Continuously excuses. And every time promise, we'll deposit this, deposit that, right? And the management basically they try to avoid the bank, right? They try to avoid the bank. And let's say that you have it's a private limited company, and then there's a board which consists of people known in the market. People known in the market who have some credibility, professionals who are serving in other boards. You find some of the directors are slowly resigning from the board. Danger signal. The directors, you many a time what they see is that, I mean, business is going in a different direction. So we being in this, our name also will be damaged. They slowly move out, right? I don't know whether how many lending officers here you know. There was a company called PC House. They are the computer sellers in the Unity Plaza. Computer spare parts and computer, parts and all the sellers and all that. So they came out big, and then they listed their shares in the market, and then the share market, the shares were going up, like it was trading at 5-6 rupees, went up to 30-40 rupees, and a lot of big people in the market were putting the board and all that, and lots of attraction. So then the company failed. I mean, eventually, because the management company failed. They were defaulting the banks, right? Banks, they were defaulting slowly. Then the directors also from the board, they resigned, and from the board they resigned. So eventual thing is what? The company totally failed, right? Banks are in trouble in recovering the loans granted. So like that, it's not overnight thing. It happens over a period of time. Only thing is that the lending officers will have to have their ears to the ground and then see what's happening, right? So they will have to, if there is a wrong signal, then they will have to follow up on that and then see what's inside, and then what remedial measures we can do so that we can avoid this facility is becoming bad and headache for the bank. Right? So deterioration of financial affairs. Financials, they are not doing the financials on time. Audited accounts not coming on time. Turnover is bad. When you have the management accounts also, the profitability figures are deteriorating, right? Or some of the figures you can't trust, right? So that kind of a thing. Attempting to disguise the deterioration through creative accounting. So many people do this, what we call is a window dressing. Window dressing is creative accounts. Creative accounts is, trying to show something which is not there, right? Which many people are very clever in doing that to dupe you, right? So you should have the expertise, your knowledge to go and look into that, look at an account and identify whether there is anything, any manipulation is there, right? Any manipulation is there. You know that when the Selinco group, was in trouble, many of the companies did have some issues. Many of the companies did have some issues in their balance sheet because a lot of intercompany transfers which was happening, loans and transfers, which normally you may not understand, but if you really go into that and then see, there are lots of fund transfers to and from between accounts, and then all that. Finally, it became an issue. And at some point of time, when central bank took Ceylon Bank and then trying to resurrect, that time they also went into this and see how much of Ceylon Bank funds have been lent to intercompanies, Selinco group of companies. So they had issues. So Ceylon Bank had a huge non-performing portfolio, which the central bank had to appoint a team and then bring them back, right? So the bank is currently doing well. So the behavioral changes of management, I told you. They're warning signals. Basically from the account operation, if you see declining current account performance. In the current account, there will be hardcore formation. The outflow may be more than the inflow. There's definitely a wrong signal because they are paying out. I mean, money is being pulled out, but then the credits are not coming. That means sales proceeds are not coming. Check returns are high. Stock payments are high, right? Round figure payments. You look at the round figure payments, business normally purchases the checks what they are issuing. That cannot be round figures. I mean, invoice values are kind of, there will be odd figures will be there. When it comes to round figures, this shows, something wrong. Many a time what happens is that people take, from money lenders, they take the money. They give like 100,000, 200,000, 300,000, 1 million, 10 million, 20 million, like just round figure checks they give. So when you find round figure payments being debited to the account, not a good sign. It doesn't mean that, I mean, they cannot be, but that is a fact that you need to probe into. You got to probe into and see. And they delay the, stock statements, they delay submission of final accounts, what you ask for, periodical MIS, and then periodical accounts, audited accounts, delay or non-submission, right? And then they avoiding bank, right? So they are unavailable. Always, eternally, they are busy or overseas, so not come to office, something like that. Those are warning signals. So you will find settlements, delay in settlements, right? Every time you need to follow up and run behind, and they keep on delaying, right? Import documents have come. They take time to come in, take the documents, and then retire the documents, right? What does it mean? That means they don't have fund arrangements, right? They find it difficult to arrange the funds, or they don't have limits, or they don't have funds in the account to retire. They delay. The more they delay, what will happen is that there will be demurrage, right? Because the goods, if it has arrived at the ports and then waiting to be cleared, the faster they clear, the better. Without paying demurrages, they can clear. So many a time what happens is that customer will come and clear up the, retire the, they would like to retire on the day they are going to, take the goods out, so that they don't pay the bank more. So their funds are properly utilized. They don't pay interest to the bank. So they wait for the message that the goods have arrived. Then they come and retire the import documents and go. So if the import documents are lying with you, they are delaying, then there is a problem. he has a cash flow issue, right? It's a problem. Delayed on unsubmission of export documents. Now they take a pre-shipment loan from you, take the money, and then money is taken for purchasing for export items. But there's a delay in submission of the export documents. So then it's bad whether this person has taken the PSL and then going and rolling, right? Not a good sign. And many a times customer will come and ask temporary facilities. Give a TOD, give a TOD, give a TOD. I mean, allow me to pay this check and all that. I mean, when that is frequent, then it's bad, right? Frequent means that is bad. Why? Because he is in hardcore position in his account, and then he is operating in excess of the limits now. So he continuously coming and asking for temporary facilities. So it's a wrong signal. Non-renewal of insurance, like customer is not renewing the insurance, right? Fire insurance or other insurance taken on assets, vehicle, all that. I mean, when there is delay, right, which is making the security unsecured for the bank, so there's a delay, right? From the financial statements, when you're looking at also when you're analyzing the financial statements and when you're analyzing the balance sheet, if the net worth is going down, normally your net worth is equal to your assets minus liabilities. You have the net worth. So if the net worth is going down, that means losses eating into the net worth, right? So deteriorating net worth means definitely it's a danger signal. Deterioration of ratios, your net profit, your gross profit, your return on assets, your return on capital employed, right? Your interest coverage ratio, right? Your capital turnover ratio, asset turnover ratio, you find deterioration, right? There is a systematic deterioration of these assets, and that's an indication, right? Worse cash flows. Cash flows are worsening, and then it shows it is getting into negative territory, right? Falling revenues. You look at the sales falling, right? Costs are, purchase and the other overhead costs are high in the account, right? So these are all warning signals which has to taken into account. There will be high turnover. You will find a lot of good staff, long-standing staff. They are resigning, right? They are resigning. A lot of new people are coming. Not a good sign, right? Strain on senior management and apparent desperation in discussion with bankers. Like, I mean, if they are coming with to the bankers in desperation, discussing, and then we want new ideas. They come and say it. I come along with the other things. Yes, that's a signal, right? And talking to the creditors, talking to the suppliers, extending the supplier credit. In the normal circumstances, all this is fine. But when all the other signals are also showing a direction, and then when this is happening, this also is a warning signal. So warning signal need not be all actually, customer in trouble or whatever, but we need to respect it. We need to respect it and then probe into the customer affairs and then see. You will find in the market customer is bargaining power. Now earlier he was asking, always negotiating for interest rates. He comes and says, say in place of 8%, you say 10%. You are asking for this 100 million facility. We can't give for this one. 10%. He says, okay, no problem. Please give it faster. That's urgently required. Not a good sign, right? High cost borrowings. So when the bank limits are used, and then bank limits are becoming, like, hardcore, you are seeing checks which are coming, which are like, shows that, they are borrowing from the outside money lenders. So outside money lenders, high cost borrowing, at the high cost they are borrowing. It's a danger signal, right? And many a time what happens is that when people are stuck somewhere, when the bank identifies that the person is in trouble, and they don't extend more facilities, they go and negotiate with another bank. This generally is a good practice, which is looked at by the seasoned, experienced lending officers, that you always look at the customers who are going to another bank and negotiating for a higher facilities with some suspicion. It is nothing wrong. There's nothing wrong, but you look at with some suspicion. Why? What happened? He was dealing with bank A, and then now they are coming to our bank and then asking for a higher facility. Doesn't seem to be a good thing. So is there anything wrong with the limits what he has, and why he wants additional facility? Or doesn't mean that all that has become hardcore there, he is not able to enjoy any cash flow there, because those are hardcore, business is in trouble. Now he is trying to take a higher facility from this bank and settle that, and then have a cash flow there, so that also eventually go and get stuck. That means the problem being transported between banks from one bank to the other. But it is the case. You need to look at it, right? This happens, whether that is the case, right? Switching accounts between banks. This happens. It's a very competitive environment in which we work. People do switch accounts between banks. It can happen. Absolutely no issue. It can happen. But as lending officers, you will have to see whether these particular accounts are being shifted because he got stuck and he is not servicing the facilities, right? So that he is coming here. That means you have to look at it very carefully. Why this additionally is asking for, whether his business turnover is supported by that, right? Current operations supported by that. Stocks, Senna, book debt, Senna, all that is supported by that. So that probing is necessary. Many people will say that I have attracted that account from here, this account from that, all that. And I also have seen some of those accounts becoming non-performing, right? So switching between accounts between banks, you need to look at with some amount of suspicion. Suppliers close their credit lines, right? Suppliers, earlier people were giving 3 months this one. They now say that we can't give you 3 months or 1 month only. Or us, they say you pay cash and take. Why would a supplier extend credit to the customer? Is that maybe he is bad in his settlement, not settling the credit on time. So if they are giving 3 months, this guy constantly takes more than 3 months to settle. So they will look at the behavior, and then they will reduce the credit period. That means more working capital requirements, right? So supplier refusal to extend credits, not a good sign, right? It's not unsustainable financial techniques. Yeah, going and taking a bridging loan from somewhere, going and taking from a money lender some amount, where the business should be, the facility should be something which should be, customer should be able to service from his current turnover. You don't go and borrow from here and there everywhere and then try to sort of keep floating, then it's only a matter of time where everything will collapse, right? It's sort of unsustainable financial techniques. The popular thing in the market is that going to borrow from money lenders, borrow from the informal money lenders from the market. So those guys will say that 3% monthly, 2% monthly. That means 2% monthly means 24% interest. 3% monthly means 36% interest. Over 5% monthly, right? We also have come across situations where we have 10% monthly, 15% monthly also. So all the time, if somebody is taking 10% monthly, it's about 120% they are paying interest. So many of the money lenders in the market, you see that, in the morning they will take somebody will take a loan, go and purchase something, especially the vegetable and all that. They go and sell it for cash, and then in the evening they settle it with the interest. So that kind of things are also available in the market. So those are unsustainable financial techniques. If your customer has, that's a warning signal. Okay. Any question here? Warning signal, because that's where you are looking at a particular account, whether it is performing or whether it is prone to go into non-performing, right? So when it shows signs, what kind of measures you are to take? You need to go and see that whether the facilities, whether it is currently, whether it is sustainable, whether we should not extend the facilities overdraft, whether we should not stop it there and then take some action so that we will recover now itself, right? Now itself, because when the customer is non-performing, when the customer is about to go into a loss situation, the person who goes to the customer, the bank which is at the doors of the customer early will recover. Others will fall behind, right? So that's what happens. We have to take, we have to immediately talk and then try to make them to make some arrangements, reduce the lines, right? Restructuring, whatever, like, you need to educate the customer also at that point, that what they are doing wrong, what they should do right, and then without falling into trouble, how to solve the situation, or worse, bank how to get out of this. Any questions?
What about kite flying, sir?
Yeah, kite flying is very much in the market, unfortunately to say. So the kite flying is that, that's what I was telling you. You use one account. From that, you transfer, transfer from one account to another account, another account, and then so that now, unfortunately, due to competition, some customers in the market have the clout. They are able to go to many banks and then establish limits. And banks are not very prudent in establishing limits also, because banks need to establish, achieve targets. Every lending officer have to achieve targets. They go and establish, similar type of limits for the customers who are enjoying limits with other banks also. And what happens is that this customer business may be not performing well, but he is able to transfer money from one account to another account, that to this, like that. He is able to show something, some turnover, settlements and all that, by sort of transferring funds between the accounts. It's a very, very dangerous thing. Now, that kind of accounts, what happens is one fine day when he gets stuck, the entire banks will fall into trouble, which is basically is happening in the market, I would say. At a high level, that is happening in the market. And it's a very, very, it's a sad state of affairs amongst the banks, because our credit qualities are coming down in the name of competition, in the name of our targets, and all that. So this kite flying is there in the market. So you need to be aware of that, wherever possible to arrest it, not to do that is important. So, but I can't say every bank is doing, right? I can't say that that's totally you should not do that is happening in the market for survival. People do that, but then what happens is that if there is a good businessman, that's the difference between good businessman and shrewd fellows. The good businessmen, of course, they know. We have many good businessmen. They know that what is our limits, how much we can borrow. Only this much we can borrow. Only this much we can do. And if the business is going up, only we may need additional. Otherwise, no. I'll settle now. For example, if you look at the current moratorium scenario, there are customers, many customers who have the cash flow to service the loan, capital plus interest. So many of them say that no, there's a moratorium period offered by central bank. I mean, we fall into that category. So give 6 months. Either capital moratorium or capital interest moratorium you give. And what happens is that the cash flow goes elsewhere. They have the cash flow, they go and put into something else, some investment, right? Right at the moment, of course, the most dangerous thing is the share market. A lot of money is going into share market. So this is a problem. This is a problem. This kite flying, what you're asking, currently is the problem. So what we do with the customers, also we educate the customers, don't do this. Your facilities are meant to be used for your business. So you take the working capital facility, you use it for the working capital facility, and then when the proceeds come, that comes to the account. That basically is it. That's it. So from there only you are able to service the loan, no more overdraft interest or everything and all that. The moment the money is diverted to somewhere else, if there's a problem, it doesn't come. It got stuck with a asset. You are in your working capital facility. Eventually, that will see the way where this will become bad. So the educating the customer is very important. And when the customers are coming and asking for limits where already they are enjoying facilities with other banks also, got to be very carefully handled. And the lending officers in the market, irrespective of the bank in which they are working, there has to be some sort of a quality maintained. Otherwise, unscrupulous customers will, exploit the market to their advantage. Even if they exploit and service the loan, that's a different matter. But when they fall into trouble, all the banks will fall into trouble. Okay. Understood?
Yes, sir.
Okay. So the credit monitoring is very important. Many a time what we think is that, okay, we put a proposal, we write all what is all rosy picture about the customer in the evaluation, and you interpret the accounts and everything, and then we put a proposal, get the proposal approved, and grant the loan. And lending officer think that we will run behind the new customer. Now, after disbursement of the facilities, monitoring part, when it is weak only, that end of the day ends up with your non-performing advances going up. Right? The credit monitoring denotes tracking performance of financial facilities from the disbursement till the full adjustment. Right? Your overdraft and all that you keep on renewing, so it's not fully adjusted. And other loan facilities and all that, once you disperse, a primary responsibility of the bank or the financial institution is to ensure that the disbursement is applied to the purpose intended. And one of the important points of failure where customer takes a loan, goes and applies for something else. So misuse of funds, and then that's it, and that ends up in a problem. Many times this happens. People take overdraft and loan and all that, and then go and buy assets. They go and buy fixed assets, immovable assets. They think that that this will go up. But the problem is that when you are taking a loan from a bank, every day with the interest it ticks. But a fixed asset, when somebody is buying, that only you are looking at a capital gain. Unless you are using that for office purposes. If you are buying office premises, if you are buying stores, right? If you are buying a shop that used to use for a business purpose and generate income. Other than that, people are going and investing in housing properties, vehicle, and all that. That doesn't generate income, right? Only way it can go up is that the prices are going up. But if working capital facilities are used for that, then that's a danger signal. So it's a requirement by the lending officer to ensure that at the point of disbursement, the disbursed funds are going into the particular purpose intended. If it's pre-shipment loan, they are buying the goods. So if they are buying the goods, if the checks are issued, you know that these particular checks are for the particular supplier. From the supplier they are buying. That only they are exporting. So that kind of a checks and controls should be there to ensure that the funds are taken and used for the purpose intended, right? Track the loans. And post-sanction monitoring mechanism is very important. So that's why you look at continuously, you look at you make customer visits. You go and do stock inspection, right? You look at the age analysis of the stocks. If you find that stocks are there which are like customer is giving about 2 months, 3 months credit period and then selling the stocks, and then if you have stocks more than 1 year, it's not a good sign, right? That means whatever money invested in stocks is working capital. If it is not rotated, if the goods which are coming into the stores are going out and then periodically it goes out and then again new stocks are coming in, if it doesn't happen, if the age of the stocks are high, that means working capital is stuck there. Many people do that. A lot of people, sugar importers, lentil, many of the if you go to almost it, buy steel and all, buy and keep it. They keep it and then they think that over a period of time we keep it so that when the price goes up we will sell, right? But for the bank, the worry is what? The guys going and using the working capital, going and blocking the funds with the stocks, and stocks they are keeping for unusually longer period of time. That many customers don't really understand that eats into their profitability. They are servicing the bank and they have this idle asset. So that's why the post-sanction monitoring is very important, right? Even if you give a housing loan, you must know. Going and purchasing a house with a housing loan, that's straightforward. You give a loan and then mortgage is executed and then house is bought and okay. But if somebody is constructing a house and if you are giving a housing loan, with every stage you go and see that whether 20% is finished, whether customer has applied his equity and put the foundation and all that for you to give the first phase of the disbursement, second phase of the disbursement, third phase of the disbursement. You will have many phases of disbursement depending on the performance of the customer, how much he has constructed. So if he has not constructed to a agreed level, the next phase will not be dispersed. Not only housing loans, even other construction premises, stores, and various other construction, building construction also will be based on that. So you observe and release so that you ensure that your fund is really going into that construction. It doesn't go elsewhere. So post-sanction monitoring mechanism is necessary, right? Post-sanction monitoring mechanism is necessary to evaluate a loan during its currency and to evaluate internal and external factors influencing it on a continuous basis, right? So all what I was talking to you in a business or in a construction anywhere, that is very important. So when we are following up the customer like that, morally customer also is bound. Customer also morally bound because he will know that he can't divert the funds. He can't divert the funds, right? So the risk indicators in this monitoring, risk indicators is very important, right? So when it comes to management, competency of the key people is important for you. You have to look at it, whether people like me who are running the business, whether they are competent, right? Change in the stakeholders, right? Say sometimes somebody is acquiring the business, right? Stakeholders changing. Somebody is acquiring the business. So who is acquiring the business? Who is taking more shares in the business? Who is investing in the business? What is their kind of direction? That's important. Now, many a time what happens is that in all businesses and all that, you have these people who are continuing with the business continuously, and then business has grown. When the business has grown to a particular level, sometimes the people who are from the beginning may not be competent enough because the business has grown. They need to have a higher competency level to run the business. But maybe the owner may be very comfortable with this is trustworthy people, but trustworthy people may not really contribute sometimes towards managing and then improving the business also. Trustworthy is good, but competency of the people also is important, right? That is why big businesses and all that, many a time they go and they hire professionally qualified people, professionally qualified marketing, professionally qualified accountants, right? Professionally qualified management people to run the business because they know, they have experience, and they have certain amount of professional ethics in running that also, and then they have a reputation in the market, right? So with that, so they are trusted to run the businesses, right? So competence, change in stakeholders, succession plan, many a times this fails. The first generation runs properly. The second generation comes, they are a spoiled lot of people who are really pampered by the parents because they are rich and all that. They spoil the business, right? They don't know the business knowledge, but they come and try to do so many things. So succession plan is important, right? Any key people who are leaving the organization is a danger signal, right? Drain of key personnel. When you look at the market or the business, the demand shift, there are umpteen number of times you would have come across examples for this, right? The demand shift, demand for a particular product shifts, right? You would have found that, I mean, there are a whole lot of studios and labs were around in the country earlier. They were developing the photos. So you go with a film roll to take photos with your camera, and then go and give the film roll to the particular, lab. They develop and give you the photographs. This is what we had been doing as students, and then as even while working, we were doing that. Now, right around the country, you have labs to develop these films, and labs to they sell the film rolls and all that. So you buy, put, and all. Now, when these digital cameras came, when mobile phones, in the digital cameras came, where the film roll was not necessary. I mean, almost overnight, these businesses gone. All these processing labs and studios, and then the camera repairing centers, Yashica, and all that kind of camera manufacturers. All of them went out of business, right? So the business trend, right? At a certain point of time, somewhere around 2008, 9 period and all that, that there was a phone called BlackBerry, very famous. BlackBerry phones were very famous. All the corporates, everybody of the higher up, they will use the BlackBerry phone. BlackBerry, you can see all the mails and all that in that, and then communication mails, and so it had a lot of facilities. Come the smartphone, when the iPhone started coming, and the Android phones came, BlackBerry and these Nokia phones world #1 earlier. So I remember I have had so many Nokia phones. This Nokia phone went totally out of the market, and then the period of these Android phones, Samsung, and then iPhones in the market, which came. So time to time, look at these photocopy machines. Right now, photocopy machines are also going out of this one because the scanning part is developing. There are scanners. Every office has scanners. They can scan and preserve documents. So they don't need to take photocopies. Photocopy usage has come down, right? Largely it is coming down. So the businesses keep on changing. Yeah, demands shift for this one. Styles change, demand shift. So the market, so we need to, what kind of a business the customer is in, whether he can sustain is something which we will have to look at, continuously we'll have to look at. There will be cheaper competitors coming into the market, right? Cheaper competitors coming and flooding the market with cheap goods for the particular thing. So whether the customer has the brand name to stand, or whether the customer will sink. The government policy changes many a time puts the business out. Many businesses have gone out of business when the government changes, policies are changing, right? Right. So when the import policies change, when the import duties are increased, now for example, now let us say a lot of people are importing, the people who are importing tiles. The tile import is restricted. Now you can see that in the market, local tile companies are also doing really well, like Lanka Wall Tile and all, telling that we had a 3 billion rupee sales, all-time high in December. And then their share prices going up really. These restrictions. Then the people who are trading in tiles, importing and trading in tiles, they are going out of business, right? They are going out of business. So the market risk. So those are indicators. When the financial risk, when you look at it, overheads, when it is increasing is not a good thing. High leverage, the finance cost and leverage is high, means it's a problem, right? You can look at it. You can look at the P&L. how is the your balance sheet? You will look at and you will know the leverage, how much is levered, how much of borrowed fund, and how much of capital they are running, whether that is deteriorating. How is the finance cost? You will look at the P&L, and then over a period of time you look at it. Finance cost is increasing or decreasing, right? Increasing is not a good sign. If it is due to interest rate increasing, generally it's a different matter. Now the finance cost of many companies have come down due to the reason that the interest rates have drastically come down. But otherwise, finance cost is an indicator, right? Where the cost is high, probably their borrowings are high, and whether it is sustainable or not. Regulatory risks are like coming from the environmental authority policies changing, new laws are coming, certain things cannot be done, certain emission levels have been, adjusted, gas emission levels, smoke emission level adjusted, certain additional measures have been brought in to safeguard the environment. Those changes can affect the business to which we have lent, right? Change in tax rates, corporate tax rates changing, withholding tax changing, VAT rates changing. These have a significant effect on the businesses, right? Now for IT companies, so let us say we are lent to IT companies. Now IT company taxes have been reduced by half, right? That's a good sign, right? That's a good sign that their tax liability is going to come down by that. Sectoral risk, right? So that's why I say the concentration risk, like what earlier we looked at, that also is an important indicator for us. If you are concentrated, so let's say we are lending to a particular sector, like condominium sector, like commodities, right? Like construction sector. So, depending on the market condition, those are indicators, right? Which is high risk, then we have to be careful. So, as lending officers, identifying and managing risk is very important. In your bank, you doing the relationship management as lending officers, and then there can be another set of people who are doing this administration part also. They are credit administration. Some of your banks will have, some of your banks will not have. Some of the banks, only the credit officer will have to do everything, right? So these are the measures we will have to do. Periodic inspection. It's a must. We'll have to do periodic inspection. Systematic analysis of financial statements. It's an art. From the financial statements, how do you look at and what do you derive it? From the ratios, what you understand, which is very important, right? So from the financial statements itself, you will be able to identify what direction the company is going, where the weak points, deteriorating points are there, right? Risk-based review frequently. So all the risks, what you look at it, risk-based review of the customer is done frequently is important. Even your risk department, integrated risk management department of your bank will carry out on a selected basis credit reviews. So the risk department is expected to do credit reviews of the credit portfolio in the bank frequently. So at least once a year, they will try to carry out credit review, right? The other most important thing is frequent customer engagement. We must always be in touch with the customer, right? If it is like gave a loan or done and finished, after that only during review, you ask for account or something like that. If we just have that, we never know. Even if the facility is being performed, running well, but the customer engagement is important. Talking to the customer is an important thing, right? So you need to know the pulse, what's happening currently, whether business is all right, whether doing, whether he's getting into any other areas, whether he has any problem with the current operations. Those structure and data are performing, whether there is any deterioration. Not looking at from the books, even by talking to the customer, you will get the pulse. While you are talking to the customer, while you are talking to any person in the same industry, you will get the pulse of it. That knowledge is important, right? Customer's MIS, management informations given by the customer, analyzing is important. Industry trend, when you know the timing, okay, there is stagnation in the condominium, high value condominium sector. There is a kind of a stagnation there. There is high number of condominium units in the high value category are available now, unsold. So when a customer, condominium developer comes and asks for a loan, we will look at it. Okay, the sector is not doing well. Risk is high. So we will have to be careful, right? Even existing customers, we have to be very careful. We'll have to see that existing customer also. Okay, if the cash flow is not coming from that condominiums, whether the customer will be able to service the loans from the other revenue streams that he has from other businesses. We'll have to look at, right? So industry trend, right? What is the trend? So time to time, many industries go into this kind of a problem. We'll have to see. Now you have the problem with the tourism sector. If a customer comes and says that I'm going to put a luxury hotel and then I'm expecting this kind of workflow, you will have your reservations. You need to have, because even the current players in the market are struggling. Unless some customer comes and says, we are a group of companies, we have a lot of cash flow, but we want to put the hotel now itself because we can buy the property or buy a hotel or put up a hotel at a lower cost now, and then we can in future, when the market booms, we will be able to have a good business. They may say, if they say, we will look at their other cash flows, whether those are good, whether from the other cash flow they can settle the loan, whether the customer is good and their performance is good, then we'll take a decision. Otherwise, if this as a isolated proposal, when someone comes, we will not go and do that, because that industry is not doing good. Tourism is not doing good, right? So industry trend assessment, market reports, right? You get a lot of market reports. In the finance market, the central bank reports will have to be looked at. In the shipping lines, there are associations, shipping associations, they issue periodical reports. The chambers issue reports, right? Chamber of Commerce, many chambers, right? Market reports, newspapers, right? We'll have to look at to understand the industry, the customers thing and all that. So all this is important. Why? Because the bank can give timely suggestion to the customer, alter the course of the customer, and take precautionary measures so that the bank's facilities don't go into a situation of non-performing, right? So proactive measures, those are proactive measures. What we are doing, our recovery efforts, providing provisioning, impairment provisions, and then taking recovery action. These are reactionary measures. We are reacting to what has happened already. Proactive thing is that before all these things happen, you foresee that. You see that in future what lies, and then you take action, right? So that can mitigate the risks, that can mitigate the facility from going into bad. So it's always better to take proactive measures than reactive measures. Reactive measures are basically is not very pleasant. Not a very pleasant experience to go and get the customer's asset and then go on a parata execution, right? It is not a good experience. For life, we are shutting the doors for the customer, right? So these are proactive measures. Lending officers should be concerned and do proactive measures. So some of the measures are like, you discuss with the customer. You tell that, okay, you are over trading. Let's you better stop it. So you can suggest that, okay, you have. I hope some of the lines which are eating into this line of business is eating into your profitability big way, so that you stop it. You do give the suggestion, like, you better stop that. When customer is going for high value asset or high value vehicle or whatever, you can suggest to them and say, maybe it's not the right time for you to do that now. You're straining your cash flow, your business will be affected. Don't do this now, right? So don't think that banks are there just to give whatever customer asks, take the security and give it. Banks are there even to put the customer on the right track. Right? That only is a healthy scenario for the customer as well as the bank. For the bank, why it is good, customer will be in the performing section and then perform the loan. Why it is good for the customer is depending on the bank to take the loans and all that. When the bank is putting them on the right direction, they thrive. They improve. They improve their wealth and they become big. So your banks are contributing towards that. So non-performing advances, what are the reasons for formations? We were looking at length. Improper structuring, maybe one of the important reasons. You structure a loan in a way which is improper, which is not exactly matching with the business requirements, so that there is enough room for customer to misuse it, then it becomes non-performing, right? Improper structuring. That's why we say, sometimes we say that, customers you need to assess correctly and then give that assess correct amount. If you give less, also problem. If you give more, also problem. If you give less, they will go and take high cost borrowing and then try to run the business. Eventually, it can become an issue in the profitability. And if you give less also, if you give more, they will misuse the funds, right? So in place of an overdraft, if you give a term loan, right, that can strangle the customer's cash flow because you are recovering the capital also. In place of a term loan, if you give an overdraft, let's say the customer is putting up a building, warehouse building, for that you are going and giving overdraft. See, that's a long-term investment, right? That's a long-term investment. That is not something which will keep on turning over. That's a one-time investment. So for that term loan only you must give. If you give overdraft, it's wrong. Overdraft will become then hardcore, right? So improper structuring. In a composite facility also, when you are having 5-10 facilities to the customer, including loans and overdrafts and pre-shipment loans, import loans, leasing, hire purchase, and so many other products, factoring, many products if you have, structuring, you need to be extremely careful. Otherwise, it's a signal where the customer can go into non-perform. Unsustainable leverage. The leverage has to be within limit. If customer leverage is high, higher the leverage, risk is high, right? Customer pressure is a reason. These days, you will find 60-70% of the cases, you'll find due to customer pressure, we are going and giving, right? People who are not experienced, people who are not very straightforward, able to, deal the credit things. And then, I mean, in the sense, it's not about telling no to the face to the customer, but making the customer understand what he should do and then what the bank can do. Very amicably to talk and sort it out is very important. So that's where customer pressure is one of the reasons. These days, it's one of the reasons. I mean, somebody is a very big customer in the market, the banks are ready to give anything you ask for, right? Anything he is asking for. Like, I mean, thinking that's what we call it, name lending, right? Without fundamentals, name lending. We do a lot of name lending, right? Because of that name. That customer, he is big in the market. His reputation is very high, right? So we can't say no to him. To him, you go and give anything he wants. It may be not a sustainable thing. It may be a wrong strategy, but still we go and support, right? Customer pressure. One of the reasons for NPA formation, right? Then the external influences. You get somebody MP calling and telling, some minister is known, somebody like, I mean, somebody known to your chairman, somebody known to your managing director, somebody is calling and telling that, I mean, okay, you look into this, give external influences, right? Based on that. Mismanagement, you find management, we look at it, mismanagement of management, definitely a reason for NPA formation, right? Changes in customer lifestyle, unsustainable lifestyle, when people have businesses and all that, they, from the borrowed funds, a lot of people show a lot of colors, right? Bank, when I went to a reception of a customer, this customer is in the travel trade. So travel trade, what do? They have travel offices in many areas, and okay, they sell tickets, no? That's the travel trade. So people go and take tickets, and that's the business. But then when I went, one of the customer's daughter's reception, I found almost about 6-7 banks in the country are lending to him. And all are seated there. All are invited, all are seated there. So I was wondering, this is a travel trade to which all 6-7 banks are lending big amounts. What have they got to do? Right? They have credit period from the airlines and they will give guarantees to them, or they will have to keep a deposit. Sell the tickets and then settle them. What is the purpose of having so much of loans from all the banks? I mean, these are the issues. So unsustainable, actually. And then the customers having, the kind of customers having BMWs, Land Cruisers, running and all that, lifestyle. So many of those things indicate that people are like, I mean, having a, luxury life, borrowing from the bank, right? Borrowing from the bank. So it's only a matter of time. It keeps on going, and somewhere they get stuck, right? The reasons. The other problem is labor unrest, right? So labor unrest is a very dangerous thing for an organization. They have unions and all that, it is still worse, right? Customers. So one of the reasons. In the management, employee infidelity, somebody playing around, right? So when the management is not very professionally managed, there are single point of dependencies are there. Somebody is indispensable. He only knows about the accounts. He only knows about the cash. Others don't know. Kind of dependencies are sometimes end up in the employee infidelity. They commit irregularities. Frauds take place. Fraudulent practices take place. Right? One of the reasons. Changes in fashion, lifestyle and trends we looked at. Technological advancements, one of the other thing. Now people are really going into anything, even in printing. If somebody is having a printing press, unless they use the latest technology, latest machines in that, they can't compete in the market, right? They can compete in the market. They need to use the latest machines. Somebody in the ready-made garment lines, they are catering to international buyers. They need to have the technology to show, they need to have the methods to show so that they can get the orders. Right? Buyers are also not going to come and simply place the order. They will see that whether you have all the technology. Right? So technological advancements, when you go to a more advanced thing, it has to be, revolved. If that is not done, it's a problem. Right? So no office can survive with typewriters now, right? So everywhere you need to have PCs with your latest Windows and all that. Even PCs are not used now all laptops, because you can work from home or you can work from anywhere. Right. Natural disasters also is a reason, because which is, acts of God, things which are beyond control. So suddenly tsunami, flooding, lightning, right? So these are things which can happen where we do not have control. Only thing is mitigatory factors against natural disasters, whether we have taken mitigatory factors like taking insurance, like advisory given not to have factories type of thing, construction near the sea, kind of so many other environmental things and measures which are taken, so that you not to, let us say, there is, if you have a in our country much less, but then in many countries there are areas which are identified as these earthquake prone areas. So earthquake prone areas, we are having factories and all that time, whether it is avoided kind of thing. Those are mitigatory factors, but these are the reasons which ends up in NPA formation. So we looked at the provisions, right? Why do you make the provision? You make provisions to say realizable value of the asset. So you try to show a realistic figure in the balance sheet, right? The balance sheet over a period of time, you are doing the provisions over a period of time. Now, like coming from every stage, SMA, right? It has become SMA. It has become, whether it is irregular, whether it has become loss category. Every stage we are looking at, and then progressively you are making the provision, so that progressively the balance sheet is adjusted. It shows the correct figure, right? If we wait till the point where it has become a loss and go and charge the full amount, your profit will be affected in 1 year. Your balance sheet will show a bigger change compared to the last year. So you show realistic in a gradual way, right? You prepare for the worst gradually without distorting at once. The other thing is you comply with the regulatory requirements. That's why you need to make provisions progressively. Okay. So your recovery of bad loans. So your recovery of bad loans. Okay. Now up to this point, any questions from you? Are you okay with this? Up to this point, what we looked at? Starting from your quality to that warning signals, your credit monitoring, what are the risk indicators you have to be aware of as a lending officer, and how do you identify and manage the risk? periodically, what are the areas, what are the things you have to look at, all that, and how NPA formed, right? What are the reasons for formation of NPA, right? What is the reason for you to make provisions in your accounts? Right? All that we looked at. Any questions up to now? Shall I proceed? Okay.
Okay, sir.
Right. Now, recovery of bad loans, there are many ways. Right. So, loans have become bad. You either reschedule or repossess, you go to mediation board, you take legal action, go for parate execution. There are many ways. Now, leasing assets, of course, leased assets you are able to repossess. Basically, if it is a vehicle, generally it's easy for you to repossess the vehicle and then, go for a resale of the vehicle, auction the vehicle, repossession. Now in that category, leasing, you have problems with machinery and all that. So when you are going for machinery leasing, okay, machinery leasing, you can take possession and auction and all that, but then, what is fixed to the ground, selling it, normally you can't remove it and sell. It's normally it's difficult. Either it has to go with the particular factory or then somebody in the same line, let us say garment manufacturing plant, means somebody in the line will have to come and bid and take it. So that they are like resale value will be much less, right? For example, now even the lot of funding we do for these harvesters and all that in the branches, that kind of things. If the harvester, the tractors and all which are used for agricultural purposes, if it is repossessed, selling is difficult, right? Who will buy? The market is much less, right? So that's about the repossession, right? Okay, then let's go one by one. Why do you reschedule or restructure a facility? So to assist the customer to repay the loan, right? Repay the loan by adjusting the repayment terms. Why? Because the cash flow of the customer has changed. The customer's cash flow has changed. You try to match to the current cash flow, right? Now that he can't, at the time of approval and granting and then paying the initial installments, he had a cash flow, but now it has changed. Like what I told you, maybe due to Corona, it has come down, business has come down due to some other reason, right? Or employee has lost his salary, or payments have come down. Oh, there can be so many reasons. So this is a measure by which before something becoming non-performing advances when you're doing, you are mitigating increase in the NPA. Even in NPA, when you're restructuring, you are trying to transfer a non-performing into a performing advance. The other thing is that you are avoiding going into unnecessary legal battle. You're not paid, if not restructured according to customer's current cash flow, customer will not pay and it's non-performing, then you will take action, you will go for legal action and all that, right? The central bank's requirements, you comply with the central bank requirements also for that, this action to build a better loyal customer base. So now if you're able to restructure, help the customer out in his bad times, to see that he goes through the bad patch without much of a problem, with a bit of a relaxed repayment terms, all that when you're doing, you are retaining a loyal customer, right? You are building a better loyal customer. You are retaining the customer. That's important, right? Your loyal customer base you are building up. That's important. Okay, when you're going for action against the customer and then selling their assets, so going to courts and all that, after that time we can't expect them to be in our customer base. Once that is done and finished, we lost the customer, right? Okay. Now the rest of the things are mediation board and all that. Hope I can cover in the next lecture. And then next lecture we can cover that, and then I probably will have to will discuss a paper. I have shown a paper in today's thing itself. We will take that up. We'll discuss a paper, and we'll try to discuss a full paper, including all ratio analysis and all that also. We'll discuss so that you know how your paper will appear and what is expected of you, right? So we'll try to discuss a paper, and then I will look at going behind. I will look at what are the areas where we have to further cover. So we'll try to have. So with that, I hope we are covering our syllabus for the course, right? So probably we will be done with about another 2 classes. And if time permits, we can have a couple of papers discussed, right? So I hope that you have done your assignments and submitted. I hope that I can correct the assignments and pass on the marks for the assignments. Then we'll be left with the final exam. So we can have the final exam and finish it probably somewhere next month. You will have your exams, I hope. So with that, you will be done with your course. So I hope you have another 2 more courses to be done, is it?
Yes, sir.
Yeah, so 2 more courses, and then with that your diploma you are completing. Right, that's great. Any more questions? Any questions? So if you don't have any questions, wish you all the best. Have a nice weekend. We'll meet up next Sunday.